The Fed's preferred measure of inflation, PCE, signaling prices ticked up in September and consumer spending surged, keeping the pressure on the Federal Reserve ahead of next week's meeting. Now, markets are largely anticipating officials will keep rates on hold again, but the data raises the prospect of more rate hikes in the future. Joining me now is Peter Borish, Computer Trading Corporation CEO and President. Good to have you on the show here. So, I want to get your takeaway here because a lot of people are wondering, you have these consumers spending more. Is that a demand issue, though, or is it the fact that they're still battling with inflated prices and that's perhaps coloring what we're seeing with consumer demand?
Well, thanks so much for having me on another interesting day in the markets. One of the major issues that one has to think about is if you think rates are going up, if you think inflation is going to go up, you anticipatory buy because you want to buy now before prices rise. So that's a little bit of the conundrum that the Fed and policymakers have. Are we front loading growth, which we just saw a tremendous number in the third quarter, and that it's going to slow down, particularly if inflation slows? We've seen energy prices stabilize. Natural gas has been low for a long time. We're going into a winter. We're here on the East Coast, obviously above normal weather. So all those things play into effect. But I think the most important issue is interest rate cycles are very long, and we're in the early stages, and it's likely that market rates are going to go higher for longer, regardless of what the Fed does.
So then do you think this latest inflation print, how much does that move the needle into the types or the pace of rate hikes that we might see going forward at the end of the year?
I don't think it moved the needle very much. I think you have to step back and say historically, unless there are major economic changes, the Fed does not like to sort of make policy decisions in the middle of a presidential election year. So we have a narrow window. The market does not anticipate anything happening next week. But if we have these strong consumption numbers, and we'll have obviously the inflation numbers, PPI, CPI, before the next Fed meeting, it's probable that they will do another rise in the front end. Now, the irony is, of course, if the yield curve goes back to normal, that's going to push the 10 years towards 5.5. And of course, remember, in interest rates, just like equities, it's never a straight line.
Indeed, and we've seen the 10-year flirting with that 5% mark. Currently has pulled back, though, but still edging up a little bit more today. What does that mean in terms of the multiples that we're seeing with equities? How should investors be gauging this period?
That is the question, isn't it? It's a challenge because there's the tug of war between economic growth, which we saw, which is good for equities, and the opportunity cost of higher interest rates, which is a challenge. So in the short run, I think that, equities after this correction will stabilize a little bit, at least into, my crystal ball gets foggy really early. So at least into the unemployment number next week, and maybe into, the election on the first Tuesday of November. And then it's going to be tricky if rates start to accelerate.
And as we talk about correction territory, we saw the Nasdaq fall into that, S&P flirting with it. What are your expectations for how that's going to roll out for the rest of the year here if things do stay at this current pace?
Well, I enjoy these sort of arbitrary numbers defining a correction or not a correction. I think as many of your analysts who've been on here have looked beneath the surface and they've seen some weakening, particularly in the broader market as it reflects the Russell. So now, again, we have another tug of war, seasonal fourth quarter strength versus the potentially slowing, as we said, if the Fed raises rates one more time, of the economy. So personally, I tend to look at sort of leading indicators. And right now, one of the strongest stocks has been Nvidia. And Nvidia has been sort of holding right along that August low. If it significantly breaks that August low, then I think that portends weakness for the market in general, right? When the strongest start to act weak, that's when you have issues. It's holding it right now. It's up today. I think it could bounce, and that's why I think the market could bounce for the next 10 days.
And what are some of the risks you think the markets are not pricing in correctly? I mean, especially when you factor in how earnings season has gone so far, but then you balance that with some of this macro data that's coming out.
So I think the biggest risk that the market is not pricing in is the fact that we could have a little bit more of a spike in the longer end of the yield curve because of supply and demand dynamics. We have a situation where China is not buying our Treasury bonds. We have a situation where so far Congress has not addressed at all some of the fiscal imbalances. We're going into that middle of November period, which is why, if you noticed, I haven't said we're going to rally past the first week of November. It's basic supply and demand. If you have a lot more supply and less demand, that means prices are going to go down. In the case of interest rates, price go down, yields go up.
Indeed. Well, appreciate you taking the time to join me this morning. Peter Borish, Computer Trading Corporation CEO and President. Have a great weekend.
You too, with pleasure.